Today we are going to just try to answer a question: how can financial statements help in understanding the financing decision of a company? When I say financing decisions, we want to understand how companies are financing their acquisition of asset, their increase in the business operation, or maybe any other activities of the business. As you all know, the business can be financed by either owner's money or outsider's money. And we will try to see what is the importance of financing a business with owner's money or outsider's money. Owner's money consists of capital and the reserves and surplus, which we call retained profits. Capital is the money contributed by the shareholders, and the profit is the money generated by the business, and together they are called equity. Equity of a company shows what percentage of the business is financed by the shareholders' contribution or shareholders' fund. The other component is outsiders' money, and outsiders' money can have a different components. This outsiders' money can come from the bankers, can come from the creditors or suppliers, or can come even from the customers or even employees. For example, if a large percentage on the sources side of the balance sheet is a creditor, that means the supplier is financing the business. If a large percentage of the balance sheet consists of the loans, that means the bankers or the loan givers are financing the business. And if the large percentage of the total sources is from the equity, that means the shareholders are financing the business. What's the relevance of understanding whether the business is being financed by a shareholder or an outsider? Because the cost of financing this or arranging this money, whether from the shareholder or the outsider, is not same. In fact, the textbook says the cost of capital, that means the cost of the owner's money, is invariably higher than the cost of outsider's money. But what is more important for us to understand is the composition of shareholders' money and the composition of outsiders' money. For example, the outsider's money, as I mentioned, can be loan, or can be creditor supplier, or can be outstanding expenses, can be advances from the customer. If you pick up any balance sheet of an IT company, you will see that most of these IT companies are invariably financed by their own profits. However, there are also cases where many of them are financed by the money received from the customers, which is unearned revenue. If you pick up Microsoft's balance sheet, you see quite a significant amount of the sources is from the unearned revenue. Is this unearned revenue having a cost? Is a question that we can deliberate upon in the next session. The cost of capital, which is a summation of cost of the debt and the cost of equity, to a large extent depend on the capital contribution or the ratio of the debt and equity. For example, if I say that the debt equity ratio, that means outsiders' money to owners' money, is less than 1, that means the company is depending on owners' money to finance its business. But if the debt equity ratio is greater than 1, that means the business is being financed by the outsider's money more than the owner's money. How come this owner's money, or how come a business is financed by the owner's money? It's possible that the shareholders contribute more and more capital by buying more shares from the market, or buying the rights issue, shares issued by the company to the owners, or it's possible the shareholders are not taking the dividends or not the profits which the company is making. If a company makes profit and the profit is fully retained, then obviously the equity goes on increasing. And it's also possible that a company may be making profit and partly distributes the dividend and partly retains that money. What will the company do with this money? The retained profit can be either utilized to expand the business, the retained profit can be utilized to pay off loans, or the retained profits can also be utilized to increase the operations, or to buy assets, or to buy some investments. So therefore, if you see a company saying that we are not going to declare dividends, that means they are conveying a very important signal to the shareholder that they are hungry for money. So therefore, the management of a business can decide whether they would like to be financed, or they would like to finance the business with shareholders' fund or outsiders' money, and within this outsiders' money, the loan money or the money from the customer or money from its own employees or from even the suppliers. So there are several options in front of the management, and all these options are important, and that is why financing decision becomes so important. At the end, I would like to say that if you ask me to pick up one particular number from a balance sheet which will throw light on financing decision of a company, it's a debt equity ratio. And debt equity ratio shows the capital structure or the financing decision of a company. And in the next session, we will try to see and understand the importance of the debt equity ratio. Thank you very much.